So in this video, we want to look at further support and resistance. So these will just be concepts that will touch on support and resistance, market structure. But then the reason you have to watch is because I want to explain this in a simplified way so that you can understand. Additionally, I want to ensure that you don't have, let me see, after watching this video, you don't have any problems with support and resistance, market structure, and also look at the heads and shoulders pattern. This is going to be explained in a different way to what you already know. So to start with, if you haven't watched any of my videos, this is your first video, don't forget to subscribe, like, and watch the other videos. So quickly, let's just look at this. This is a trend line. Sorry, this is an uptrend, a trending market. We have this, right? Then in my earlier videos, I said these levels where the market fails to go any further up are called resistance levels. These levels where the market fails to go any further down are called support levels. Let me erase that. I'll just go through this quickly because I have a video that explains this in details. Just check it out. Let's see. This is our downtrend. The same applies. So let me just get that. The market fails to go any further up there. So that's called our resistance level. The market fails to go below this. So that's called our support levels. I have a video on this that explains everything in details. So you should go watch it. Now, I was just explaining this in brief so that I put things in context. Now, let's go back to this market. The first thing you're going to notice here is that we were in an uptrend, but there's a point where there's a market shift. Now, a market shift means, for instance, if we were in an uptrend like this, we're in an uptrend made up of higher highs and higher lows, like that. Where the market changes direction, this point here, it can be discovered by paying particular attention to market structure. You notice that in order for an uptrend to exist, it needs to have, I'll just donate this as HH, higher highs. It needs to have these higher highs. Copy. It needs to continuously make these higher highs. Like that. Like that. And higher lows. So let's see, no, let me just copy this in. Then we'll change these two. Change the text to higher lows. Higher lows. So it does that. Does that as well. Yeah. You've seen, right? So this is the structure for an uptrend. Now there's going to be a market shift right around this second area. How do I know? Because the market has failed to go past these previous higher high. Since it has failed to do that, from this point on in time, we'll only be taking shorts. What I mean is, from this point on, since the market has failed to break past that level there, the market has failed to go past this level. Even if this other side is showing that we are in an uptrend, the fact that the market here has failed to go past this red line I've just put, where the arrow is pointing, it means that we have shifted. There's a market shift. Hence, you're only supposed to look for shorts instead of longs. Now, for most people, they would have known that there's a shift if they had like drawn these trend lines. If you had drawn trend lines, you would have known that we had changed momentum here because there's some kind of a breakout, some form of a breakout here. But if you want to advance your pure price action strategy, even without this trend line, you would have been able to tell that we had shifted in terms of market sentiment. Instead of an uptrend, we're in a downtrend. Now, the mistake most people make is this. They'll zoom out of the market. They zoom out. Okay, let's just try it on a real chart so that you see what I'm talking about. You see, if I was to zoom out from here, right? And I just look at, starting from here, I look at this market, starting from here. I know that this is going in an uptrend. But then at the point where this market here, at this point here, where there was this market shift, if I'm just going to follow, let me add this. If I'm just going to follow this, I'm going to assume that this is in an uptrend. Even if this here is happening, I'll still think this is an uptrend. Why? Because most beginner traders will just zoom out like that. Then they just see this going up. Then they assume that this is an uptrend. But in the actual sense, the market at that point where I've drawn the circle will zoom in. It has created a market shift that tells me that this market is going to drop. How would I have known that? So let's get close. By the way, the point I was putting across for support and resistance is this. Don't think of support and resistance only here where the market has already passed, like this point here. You say that, okay, this is some form of support level. You go on top and you say this is another support level like that. What I've done is fine, but what is even more important to look at is just the most recent price action. So I want to look at this level and I want to look at that high. So this is my support, that's my resistance. Why is it important to do it like this? Because then you know that if the market breaks to this downside, you are in a downtrend. If the market breaks to the upside, you are buying because you are in an uptrend. You've seen, right? This gives you an easier entry, or it gives you a faster opportunity that you can actually trade. This happens on every market. So for me to solidify that point, let me just do this. Let me just pick any random market. Let's see. Let's go to that Australian dollar. So now this, let's say the market is still somewhere right around there. So what am I going to do here? I'll just get my horizontal ray, put it on the highest point, that level, then I'll get it again and put it on this lowest point. Let's say the market has just formed this. So what am I going to be waiting for? I'm going to be waiting for a break on either side. Either the market breaks to this side, it means I'll be buying when an uptrend, it's continuing this trend. Then if it breaks below, I'll be waiting for a sale because it means the market is in a downtrend. So you can see this is what happened. The market pushed below that. So that's one secret you can use. In fact, pause the video and just open a random chart, go back where you see some price action levels, mark them out and ask yourself where you are going to have your longs or buys from and where you're going to have your sales from. So let me just, to solidify this, let me just open another random chart. Let's see, USDCHF. Okay. So this was my analysis. Let me remove that. So then let's say the market is just from forming this high. It has formed this level. And then the previous low was this point here. So what I was saying is you wait for the market to break on either side. If it breaks here, you're going to be buying the market. If it breaks below this, you're going to be selling. Now, how do you even know that it's about to break or not? Remember candlesticks. I'll create a video. Actually, people asked me about that. So I'll surely create a video on it as well. So then here what I can see is there was this rejection. You can see we have a lot of weak rejection on this level. Then the market created some form of a double bottom with multiple weak rejections. And you can see this was like a morning star that follows. So here you know that you are buying all the way to that level. But you buy all the way from this point to that because here you might be expecting some resistance. But looking at the way the market was coming, you would have been able to tell that this was going to continue. Why? Because of the momentum candles here that are present. All right, let me do this on another thing. Let's just look at US oil, for instance. US oil. Okay, US oil seems to be in a very big range. So let's say this has just happened and this. We haven't yet seen the drop. So the market has pushed, starting from here, going all the way down to this point. So what are you going to be waiting for here? You're going to be waiting for either a break to the downside before you can enter for a short position. You have to wait for candlestick confirmation. Now here you can see that there was this strong push to the downside. Then we had this weak rejection here. We had some weak rejections. Once you see weak rejections, be wary. In short, don't just enter the market. You have to wait because this means that there's a strong opposing pressure at this level. So what do? You wait for confirmation to take this back up all the way to that level. Does that make sense? This can be done on any currency pair or commodities or whatever you're trading. Let's just see. Let's say we have USD or GBP USD. You have this. So what you want to look for is just the most recent high the market has made. Just pick that. You're saying this is your most recent high. Okay, done. What's the next thing? The most recent low. So we're assuming that this other part hasn't yet occurred. You've just seen this and the market has started dropping. So what are you going to be waiting for? You're going to be waiting for the market to go back to this level here, this one. And then you wait and see how the market reacts at that level. So remember, I said weak rejections. There is strong indicator that there's a high rejection of that level. Hence, the market is likely to go in the opposite direction. Then you can see from here, you just take this trade all the way up to that level. And these support and resistance, the ones I'm drawing, are the most recent. You can see these are just like where the market currently is. So you don't have to like so you don't have to like go back way back. Like what I was doing, this was a general analysis for like to get an overview of everything, of what was going on. After you're done with that, when you narrow down everything, just zoom in to the most recent price action level. Like here, if I see what the market is currently doing, what I'll just do here, I'll just draw that there, my horizontal raise, and another one on top of that. So I know that whenever the market breaks this level, it goes back for a retest, I'm selling. If it breaks above that, goes up, I'll be buying. It's as simple as that. Okay, so let's go back to gold. Now, I go back to one thing that I had mentioned earlier, which is, by the way, try to pause the video and draw support and resistance, the most recent support and resistance levels on any currency pair that you want, or even a commodities, anything, it works. So now what I was saying is, for market structure, why most people get it wrong, they focus on the general structure of the market. Like for instance here, let's say till that level. If I just look at this on a general level, I'll say the market is going in an uptrend. And that's what most of you are going to say. Then, why that is wrong, let's discover that. It's because you haven't zoomed in and found out what is going on. So you see, in order for a market to be in an uptrend, it has to be making higher highs and higher lows. So what was happening here? We saw the market pushed up, it made this low, pushed up, made that low, pushed up, drops, made this low, pushed up, and then dropped all the way to that level. Now, my question is this. What makes an uptrend? So now, if you go back to what we had done earlier, we said in order for a market to be called, or in order for a market to have an uptrend, it has to be making higher highs. It has to be making higher highs and higher lows. So you can see here, it was making these higher highs. So in short, here we were in an uptrend. But then what happened? We see the market. Let me just do this. Let me just change this. To a higher low. Okay, so the market has to be making higher highs. You can ignore the wicks, just focus on the bodies of the candles. I'll explain more about the wicks. I'll explain more about the wicks in the candlestick video that I'll release shortly. Now here's the fun fact here. Once the market failed to break this high, let me put my level there, my horizontal range. Once the market fails to break that high, despite you, even if you were to like zoom out of this, despite you thinking it's an uptrend because you've been seeing all these higher highs there, at this point, there was a market shift. Now that market shift is what tells us that we are no longer in an uptrend, hence we're in a downtrend from here. So the market failed to break that higher high. What did it do? Instead, it made a lower high. So it made a lower high. Now, if you know anything about market structure, you know that a lower high is always in a downtrend. Then what couples that downtrend? What couples that downtrend? Let me see. Have that. Okay, let me just change this to a lower low. So the market made a lower low here. How am I able to find these levels, you may ask? So you just look at the point where the market moved in an impulsive way, then made a correction. A correction is just a 10. So let's say we are coming with this level. You can see from this point here, it sort of made a 10 going downwards. Then from this point here, sort of made a 10 going upwards. So you get the idea. So let me now remove this. They'll just flood our chart and that as well. So you've seen here there's a market shift. So now you know that in order for this to be called an uptrend, we need to break above that level. And what does the market do? It fails to go past that. It instead forms a lower high. Once the market forms a lower high, we're waiting for it to form a lower low. Now, this lower low proves that this market is no longer in an uptrend, but in a downtrend. So what are you going to do? From this level here, you mark out that level. The market is always going to try and retest these levels. Remember, I said support is just the immediate level that the market fails to go lower, and resistance is the immediate level the market fails to go higher. So this is our immediate level. The market has failed to go higher than this. So what are we going to be doing? We're going to be expecting the market to go back and retest that level. So it continues. Here the market makes a lower low. Here there's somehow some form of minor shift. The market forms a higher low, more like it's pushing to an uptrend. Then this breaks way past this level, making this to be called a higher high because it's higher than this level. You get the idea? So there's a shift in market structure here when the market makes, let me circle this point that I'm referring to. This level here, you can see, I don't know why this is not. I'm just trying to get something else. Let's try the highlighter, see if it will work. Okay, it's worked. So this is the level I'm referring to. You see there's a shift in market structure here when some form of a downtrend. Then we see the market trying to form an uptrend. How do I know that? Because this is a structure for an uptrend. You see, right? This can be thought of as a higher low, and then this is a higher high, higher low, higher high. Now what happens? We broke that level again. How do I know? Because when I look at this level here, this is a higher high. Now, in order for the market to continue in this new uptrend it's forming here, it has to not go below this level. It has to continue from here, reach maybe somewhere around reach somewhere around this level, and then push right back up and break this previous high. But what does it do? It goes down below that level, forming what? I'll give you 1 second, pause the video and try to guess what it has formed. Yes, so if you said lower low, then you are right. It forms this lower low. You see, so that's a shift in market structure. And then this level here where I've put this line, let me just use this. This level here is a key area because remember I said support is just the immediate level the market fails to go any further down. So here the market has failed to go any further down. It breaks that level, goes back for a retest. So from this level here, what am I going to be expecting to happen? A rejection. And you can see these wicks have given me a nice rejection. Once I see that rejection, I enter into this market for a short all the way down to that level. Now for me to come up with this level, that's where I can now use any previous levels that we might have had. That's when these previous levels become relevant now. So I'll say those will be the key areas that I'll be watching out for. These levels here. All these three will be levels that I'll be looking at. So that's how you would have known that these had shifted into a downtrend, even if when someone looks at it from a general perspective from there, they'll think that this is this is in an uptrend. But in the actual sense, if you follow the patterns here like we did, if I zoomed in, you notice that it was no longer in an uptrend, there was a market shift. See, right? We failed to go past these highs, formed a lower low, hence failed to break past the previous higher low. Hence, this has formed a downtrend. So the next thing we want to look at, by the way, practice this. You can actually, let's see, let me just use another example where we had like a market going in. Okay, let's use this example. Let's say, let me remove everything. So this is the market, right? It's moving in an uptrend. If you just zoomed out, let's say we didn't have that. We have till that level. If you zoom out, you might think this market is going in an uptrend, isn't it? Most probably you say yes, because you'll be looking at this in general. Okay, we're pushing up. But then with what I've just explained, you realize that there was something going on here. In order for this market to be called as an uptrend, it needs to qualify in a sense that it needs to have, it needs to be constantly forming higher highs and lower highs. So you can see the market here from the higher high, lower high, pushed up, high high, lower highs, then there. From this level, we had a problem. The market failed to break past that level there. Once the market fails to break past a higher high, it's no longer in an uptrend, it's in a downtrend. Because remember, based on market structure, we said in order for a market to be called as having an uptrend, it needs to be constantly forming those higher highs, which is what it was doing. Let's see, I'll put one there as well. And it also needs to be forming higher lows. Remove this. And we change that to a higher low. Okay, we'll copy that. Okay. It needs to constantly be forming this, which is exactly what it was doing. And remember, the market doesn't have to go below these levels. And now I'm only considering the bodies of the candles. I'm ignoring the wicks on purpose, that level. You've seen, right? So the moment here the market had failed to break past that level, it came back to this here. We're going to take this market to be in a bearish trend because it has failed to break past this previous higher high. So then what happens? As I explained, right, I explained that once the market fails to break past that, instead of forming a higher high, it formed a lower high. Let me just remove this. So if you follow everything I'm explaining here, it just means that you become a pro at this in no time. Once you're able to do this, just near the current price action, once you're able to do that, you become a pro in no time. So let's see. The market formed a lower high instead of a higher high. Now, a lower high is only present in a bearish market. So then what are we going to be doing? We're going to be waiting for the market to break past this higher low. Because if we're going to say that this is a bearish market, which has now started forming here, you can see even this level is okay. So let me just add this text. Lower high. Oh, sorry, lower low. If we're saying this is our lower low, by the way, I'm only considering the candles, not the wicks. You see that this is lower than this previous one here. I'm talking about this level. You notice that there's that difference. Same, right? So that means, despite when you zoom out, you think that this is going in an uptrend. You're not wrong. This first part is in an uptrend, but the moment the market reaches this level here, there's a shift in market structure because we failed to go past the previous higher high. Hence, once the market failed to break past that level, that's the importance of drawing these two support here and resistance there on the most recent price action, because it helps you to be able to tell quickly whether the market is still in an uptrend or a downtrend. If you're getting confused with these names like higher highs, low highs, blah, blah, those things seem confusing, just draw these two lines here and be telling yourself that if the market breaks on the upside, we're still in an uptrend. But if it breaks to the downside, we've shifted to a downtrend. That's an easier way of knowing whether you're in an uptrend or a downtrend for a beginner. But for people who already know what I'm talking about here, you can also use just market structure. So you notice that here, the market formed a lower low. You've seen, right? So this has already told you that this market is no longer in an uptrend, but in a downtrend. So what are you going to do? You're going to wait for the market to break this previous higher low, this one. Because once the market is just hovering within this area, there's a chance that it was only consolidating and it breaks to the upside. So you have to wait for it to actually break past this level so that it's invalidated. We can see this is what the market did. It broke past that level. And then what you want to do is wait for it to go back for a retest, which is this. Then the last thing you want to do is now pay particular attention to the candles that will be formed at that level. You can see it formed an evening star structure here. So once you see that, you enter, then your take profit targets will be these previous levels, key levels. So you can have your TP1 at this level, then your TP2 at that level. So you can see the market is still pushing probably to reach that level. So this is how I want you to think about market structure, support and resistance. And then the last thing is, I don't want to make this video very long. So then the last thing is this idea of the heads and shoulders pattern, this. So whenever a market turns, you notice that there's always a structure like this formed. The opposite of this is market is going to the downside. I'll explain this on a live chat. Like that. Then this straight line that you can see is called the neckline. Okay, with that in mind, let me see. Before a market turns, remember I said if we're in an uptrend, the market will be making higher highs and higher lows like that. It's pushing upwards. But once the market fails to go past that, it reaches somewhere right around there and then goes down. You can see that, let me just adjust this a little bit. You can see that at this point, it has formed some kind of a head and shoulders pattern. If I was to bring it now, it would probably make sense. You have this shoulder, your left shoulder, then you have this pushed to the upside, you have that, then your right shoulder. Then you're expecting the market to break past that level. You've seen, right? So this structure here is a reversal pattern. Whenever you see this, it means that the market has changed and is going to the opposite direction. So for instance, this was an uptrend, so expect the market to be going in a downtrend. But then you have to wait for the market to come back either to this level here, that line, or these two. Let me see. You're waiting for it to either come back to that level or it should come back to this level. Retest either one of those levels, get your confirmation, put your stop loss just above. If you don't want to be wicked out, put it just somewhere above the neckline. Let me just adjust it a little bit. I think we're fine though. Push this to where the market started from. And push that a little bit down, somewhere around there. And this is a 2.5 risk to reward ratio, which is not bad. So you want to put your stop loss right above that, because you know if it breaks these two levels, it means it has started forming an uptrend here. But overall, we can say this is a downtrend. Why? Because the market has failed to go past this level, which is a new high. The previous high that the market had made, it had failed to go past that level. You see, this left shoulder didn't reach that line. So because of that, and based on market structure, the market has formed a higher low. Now, a higher low is only present in a bearish market, not in an uptrend. Hence, this tells me that the market is likely to start going down. Now, I'll be waiting for it to go back to any of these two levels. If I get a good confirmation, I'll trade it to the downside. The mistake most beginners make is whenever they just see these two here, those lines, they'll assume that this is an uptrend. So they'll only be looking for for longs, for buys, which is not the correct way of trading the market. Because once the market makes a certain market structure shift, it means whatever has happened here is invalidated by what is currently happening. These will only be important to give you possible profit targets, like there, and then where the market started from, there. Hope that makes sense. Now let's try to apply this on the live charts. Let's see. So my hypothesis is whenever the market turns, it had formed that heads and shoulders pattern. So here you will notice that we had some form of heads and shoulders pattern. See those that pushed there, the market dropped to that level, it pushed up, dropped, failed to go past the head, dropped back again to that level. So this is a heads and shoulders pattern. Once I see that, I'll be waiting for it to break. This is called the neckline, this dotted line below. It's called a neckline. So I'll be waiting for the market to break below this, which is what it did here. Once it breaks that, my other confirmation will be wait for a retest. I wait for a retest. Once that is done, what am I going to be waiting for? I'll be waiting for candlestick confirmation on that level. Once I get my confirmation, you can see this was an evening star, some form of an evening star. Once I get that, I trade to the downside. Then my profit targets will be, because you already have to know where you're exiting the market if you're wrong in your analysis, and where your profit targets are. So these two are my profit targets. So this is TP1, TP2 is here. Then my stop loss has to be right above, to avoid being wicked out. Once you enter the market from this level here, you're supposed to put your stop loss just above that level, those wicks. Because you know that if the market goes above that, it means this trade setup is invalidated. Then your profit target should be all the way, your TP1 should be like right around there, which is a risk to reward of 1 to 2. Then this will drop all the way to that level, which is a good risk to reward ratio. As you can see, the market is still moving, probably to push all the way to that level there. But even here, if you're happy with the profits, remember, you're not looking at perfection. You're only looking at making money, and that's all. It's not like you're trying to, it's not like you're trying to be perfect with your entries or exits. The only thing that's important is whether or not you're making money. Hope this helps. I have another idea that I would love to share, but I'll do it in the next video. I don't want this video to be very, very long. So I'll see you in the next video. Don't forget to subscribe, share, and like. If you have questions, leave them in the comment section. I'll get back to you.